What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is November 24th of 2019. Well, folks, I hope you are having a fantastic day wherever you are. And in today's video, we're going to be talking about a wide range of different topics, from taking a look at Bitcoin, Bitcoin dominance, as well as a few key altcoins that we're watching, as well as a plethora of economic data that can give us a good idea as to where we are in the current state of the economy. So we're going to be talking about all that and much more in just a couple moments, right after our quick sponsor. Our sponsor for today's episode is DNA. Dual Chain Network Architecture, or DNA, is a next-generation blockchain incorporating the 5 pillars of public chains: identity, security, oracles, scalability, and interoperability. DNA is built as a scalability solution running parallel to the Metaverse ETP chain, which launched back in February of 2017. DNA will facilitate extremely high transactions per second in Lightning channels, making use of pre-existing relationships between nodes. To keep up to date with the project, you can follow them over on Twitter at MVSDNA, or you can check out the link down below in the description to check out their website. Alrighty, everyone, so let's go ahead and start off by taking a look over the market at the moment. Luckily, over the last 24 to 48 hours, things have remained relatively positive. We can see the vast majority of cryptocurrencies holding a slightly positive trend. Again, not too much to the upside, but again, at least it's green for the most part. And we are seeing some altcoins make a nice rebound back. Synthetics continuing to rally. We got VeChain doing well. Again, good amount of players in the market holding up here towards upper single digit territory, gaining in the market. Right now, we're seeing valuations slightly below $200 billion. Again, we are seeing a general hover around there. And again, this is why I've said it's very significant to watch these big evens on market cap, right? We'll get some slight variations here of $3 to $4 billion above or below sometimes when we're coming down to retest the support. But again, we're seeing, generally speaking, that we're around the same area here, and we're seeing that buyers are coming in at the same range, right? So it's not something to fret about. This is, again, one of the points where people are really capitulating in the market. And to me, the more I see of that, where people are like, I don't see Bitcoin going up for months. In that case, I usually get very bullish because that's exactly what's happened in commodity markets on a longer term time frame. I remember last year, back in 2018, people were like, I'm done with it. I'm done with holding gold and silver. And these were the same people who bought, in many cases, towards the top. But if you're part of the anomaly, if you're part of the people, or I guess the contrarian viewpoint in this case, and that have held through, and vice versa in this case here as well, or I guess not vice versa, but as well as here in crypto markets, then again, I don't want to tell you guys what to do, but I think it's going to pay off. That patience is one of the greatest assets that so many people don't have in these markets. And again, I don't like to sell into a 50% correction. I like to buy personally, but everyone's going to determine what they want to do themselves. In the case of market dominance, we'll focus in on that in just a moment when we take a look at the chart. But I want to talk, again, I want to play devil's advocate here, right? So we're around $7,100 at the moment. Is there a possibility we could still continue downward? Yeah, probably. And the level that I'd be looking for is for us to retest support. A lot of people were calling for this, who were a little more bearish back here. It was a very select few players, right? Again, because you have to have that contrarian view at the time. And a lot of people called for 61 to 6200 retest this key support level here, where we tested multiple times before we had the breakdown, right? So could we end up getting that? Yeah, it looks like, for example, today we are rolling down a little bit here in the sense of price action. We take a look at the hourly, we can see that a little more clear, where there might be one more sell-off here. And it might go over the course of the next 24 to 48 hours, or it could be at a slower pace all the way here to mid-December, right? But keeping that in mind, that is the most bearish scenario that I see possible for Bitcoin. And either way, I'm still on par for believing that throughout this year in 2020, the next coming year, as well as 2021, that we're going to still be on pace for the cycle, right? We're still on pace for Bitcoin to make higher moves. And again, I want to emphasize a very key point here, guys. A lot of people would say, Nick, how can you still remain optimistic after what would be a 55% correction, right? We're sitting at about a 51%. I'm probably not going to be able to get the precise number, 51, 52% correction at the moment. How could you even be more okay, or just normally okay with the idea of having a 55% correction? Well, the one thing that I always emphasize to people, and again, this is the point I really brought up about Willy Woo's data science model that Bitcoin is supposedly going in to a halving period in a bearish trend. The fact of the matter is, guys, is we're not only months away from the halving, but we exited out of the accumulation phase way too quick, right? Again, let's take the drawings off the chart here and just take a look at the time range here, right? Going from January here in 2015, taking a full year, right, to get back up to this range, right? January 2016, we only went from about 200 up here to about 350 at that same time period a year later, right? Well, when we set our bottom in here in December 10th of 2018, we're about to enter towards December of 2019. And we've actually increased more on a percentage basis, not to mention on a much larger market, right? If we even held around 6,000, it would actually line up quite nicely with history, and we'd still probably be outpacing history. So that's my point here, is that we had an overtly exuberant rally. We got out of the accumulation phase, really the bottoming of the market, at a much quicker rate than before. So when people, look at the standard price, they're going to look at this weekly and say, oh my God, the chart looks ugly, right? They're going to say, oh my God, this is so much of a shock response, and it's such a stark sell-off here. And actually, I'd say more than anything, people don't focus on the fact that we had a really premature and exuberant rally. God, I don't use exuberant as much. I know you guys are eager for the bull market to come so I can start saying exuberant over and over again. But it's true. We did have an exuberant rally, and because of that, we're going to have a sharp correction. It was too much too quick. And this happens in a ton of markets. It just happens in Bitcoin a lot because we're still in a very early emerging asset class. So I think it speaks to the positives of Bitcoin and the predictability in this case that with exuberant rallies we're also going to get exuberant corrections. And we've seen that throughout Bitcoin's history, these massive parabolic run-ups in cycles and then 80% corrections. It's very, very common. Now we've realized that, right? We've talked about that. I want to dive into a few economic models, and then we'll dive back into taking a look at altcoin dominance. Again, one that we've been talking about is the 2-year multiple, right? Again, we had this correction come back down to the multiple. We had a correction back down to the multiple, the MA in this case, the moving average. I keep saying multiple. But the 2-year moving average, you can see here that we rode along this for a very long time. And both times as well, we really did come down and possibly dip not only directly on the 2-year moving average, but here you can see we've dipped slightly below it, right? Again, so long as it holds around these major moving averages, I'm fine with that. If it starts to get a little too divergent, right, if we start breaking below the 6,000 region, that would be a little bit concerning to me, right? As we talked about, that is a possibility. We could see it come over here in the next few weeks. But again, you're getting into a territory where I would hopefully expect most of you are not feeling bearish, rather than just feeling exuberantly bullish. You just understand that the risk to reward in this case is probably turning favorable, right? It's getting to a point where this is not a period of time for capitulation and being fearful in price. We've already seen a 55% correction, and we did exactly what we've done historically, right? When we had these exuberant rallies, you can see back here in a much smaller market. You can see here we had this very short accumulation phase, the exuberant rally out of it, and then we had a sharp correction down to this line, right? Going down from what was, again, we'll actually have to probably get the exact price. It was probably around $5 to $6 going down to $4. Might have scared a lot of investors, but that's what we had. And then we weighed down on this moving average and slowly waned off of it and entered into the next cycle. And had multiple periods of time where we tested above the 5-year multiplier for the 2-year moving average, which is a good sign that we were in an overextended market. Now, another thing as well, again, I'm just going to re-hint this, guys, until we get to the halving, right, until we see a lower divergence off the halving, I'm not bearish. We're right on track for where we should be, okay? This is one of the key models you should keep your eye on at the moment. Now, let's go ahead and talk about a few more things crypto market related. If we take a look here on the weekly, right, we've been watching Bitcoin dominance here, but we can see how altcoin dominance has been setting in greater levels of support here. If we take a look at the daily, the multiple days that we had a Bitcoin dominance gain from around 68 to nearly 69 has dropped in a matter of a day here, and we're starting to see altcoins regain that dominance back. And if we continue over the next day or two with this trend, we get to a point where we break below 68 and might obviously start sparking an even greater rally for altcoins in this case, as we see maybe a recovery in Bitcoin, right? And that would definitely go against much of what we've seen before. But what gives me this confidence that we're going to see this is that we've been setting lower highs each and every time for Bitcoin dominance, right? The trend is very clear. Lower highs and roughly lower lows. It's all a matter of what happens here at 68%. If we get a significant breakdown towards 66%, that to me would be enough of a confidence side, a 2-point drop there where you can see the trend is obviously reversed, right? There's been enough cases where we've seen lower highs and lower lows for us to be confident that that cycle is going to continue, especially with Bitcoin being this low, right? With Bitcoin being able to increase towards its 20K level in this case, it's going to give altcoins in this case hopefully a lot of momentum as well, right? I don't know if we'll see that this time around, but I'm just waiting for that 68% mark thing. That's really all you have to look for. Now outside of that as well, we'll take a look at a few of our plays, right? You guys know I've been most positioned at the moment in Link, right? Link's still holding up well. Obviously faded off a good amount of its gains over the last week or so with Bitcoin selling off, but also in the sense of its comparative to Bitcoin, right? We also decreased a little bit. So again, I like so far that it's holding up here. And again, if we take a look at the broader trend, setting higher lows here, right? Testing up towards this resistance range. The moment this curves up and breaks up above 36,000 and really starts to pick up, I have an alert here to let me know. I think that is when we're really going to enter in to Link picking up, entering into its next cycle, right? It's been kind of in this sideways movement here because it's taking on the fact that in this market, it has outperformed pretty much every single altcoin. So for it to continue there needs to be a kickstart. There needs to be a movement and much more volume coming into the altcoin space. Outside of that as well, we've got BAT, right? We'll go ahead and take a look at BAT here on Bittrex, right? See BAT here holding nicely, right? Just like Link, it's holding up near its resistance range in the short term. And again, this is a very significant level, right? Because you can see we generally topped out here at 3,000 sats, down here as well around 2,900, right? This range around 3,000 is a pretty key level here for basic attention token. So if we can get a nice breakout on volume, that's going to probably spark the next rally here. It's going to kickstart and lead us towards some really nice levels to watch later on in 2020. Okay, so that's what I'm watching for. No complexity, no crazy amounts of indicators. Our weekly indicators across all of the cryptocurrencies are still looking fine. The momentum is there, and that's really all that matters, especially on the weekly time frame. Now, one last one that I'll take a look at is Raven. Right, this has been another one of our plays we're watching here. I'll go ahead and actually pull it up here on Bittrex so we can get a little bit more price action. But so far, again, significant higher low here. This is what I want to see. Setting a low here, setting a low here, and a higher low range up here. History repeating itself. And it's just a matter of finding volume and follow through on price action in a matter of a couple of weeks, or who knows, maybe another month or two. We don't know how long we're going to push sideways here. But at least buyers are coming in at this Bitcoin comparative level. That's what I want to see. Okay. So anyways, I rambled on enough about crypto. Let's go ahead and talk a little bit about some interesting data points in traditional markets. For those of you who are like me and you're junkies on data and you love to see where things are going, well, this is a pretty good kind of plethora of different things. So I'm using Advisor Perspectives. This is just an interesting website I saw that has so much different interesting like data points, and they push out stuff all the time. But I like to, just kind of dive through this stuff from time to time with you guys. So one of the things that I think is very important in measuring economic activity, real economic growth, is gasoline volume, right? The amount of sales that you're seeing for gasoline across the United States. And also talking as well about the discussion that we've had on the channel about the declining demand for gasoline in the long term as a commodity. You guys know I like to keep an eye on commodity markets. I've traded commodities in the past, right? So when we take a look here at total gasoline sales, there's a very interesting trend, right? So this is just going to show us, generally speaking, the very simple data of the total amount of gasoline sales by prime suppliers, right? And we can see here that we're down about 2.7% here from our recent peak, right? We can see that back here since 2005, we've never been able to overcome that original peak in gasoline sales. So as an industry, whereas for the last few decades we had consistent growth here in gasoline demand, we've actually set a lower peak in this case, right? And we've now started to enter into a decline throughout the later part of 2018 into this year, 2019. And it doesn't look like there's going to be any signs of this changing, right? We're actually seeing what might be a very long-term trend of declining sales in gasoline. You can see here as well that it's reflected in price. There has not been, with the amount of the glutton supply that we've had over the last few years, we have seen price way down here as this demand is starting to stagnate over the last decade or two. And it's very interesting to see that kind of correlating in within price, right? So the red line here indicating price, measuring somewhere around, if I'm reading the chart correctly, around 250, a little bit above 250. So again, very important data to take into mind when just a few years ago, right, the norm here was around $4 or the upper $3 range. Very good amount of savings for the average consumer. This means that money can go elsewhere, going to paying down debts, going towards spending in other sectors of the economy. But it shows us that people as consumers are not consuming as much energy as they used to, or at least they're not consuming as much gasoline for their transportation, right? So a very interesting trend. Less commuting, right? It's a mixture, right? There are more EVs on the road. There are a lot of other ways that people are transporting now, not to mention people just probably transporting less with more people working remote or from home. There's all those kind of interesting factors we have to plug in. But this is what I think is the most important. If you really want to get a measure of, demand for a commodity per consumer in this case, right? This is really what matters here. Even with a declining or growing population, you want to see growing demand for a commodity in that case to get really bullish on it per capita, per individual. Well, over the last few decades, we have seen the complete opposite, down 20% since the peak, right? So they averaged about 1.8 gallons per day per capita, and we're now down to around a little bit above 1.4. And this has been a multi-decade decline here, right? No wonder in price in this case, especially in a population in the United States that hasn't really been growing. This is why we're seeing this, right? This is why price is where it's at. And I'm surprised it's actually not a little bit lower. But to be fair, we have to factor in inflation, which this price is probably, well, maybe it is actually factoring that in because it's real price. That's an interesting topic or interesting thing to keep in mind. I don't know. It'd be very interesting. I would think that the real price is much lower here because of inflation over the last few decades. I don't know. I guess it is the CPI, well, the Consumer Price Index adjusted price. The CPI is, how do I put it? Well, let's just say it's a little soft on the inflation numbers to be realistic. But yeah, we'll go with the real price being a little bit lower from where we are. And that's why we're starting to see, and this is why I actually wanted to bring up these charts here, why we're seeing a lot of U.S. producers U.S. refinery throughput starting to decline here. Not to mention the amount of exports from the United States, right? Exports for finished petroleum products from 2001 to 2019 actually entering into the negative region for the first time since 2013. Right, so we didn't even have this back in 2015 and 2016, right? We had low numbers, but we were still increasing exports in this case, even during the real kind of flash crash in oil prices over a multi-month period, right? So going on here to talk outside of oil prices and gasoline, talking a little bit about existing home sales as well as new residential developments. I want to talk about the property market. We haven't talked about this in a while. So as you all might know, as we've kind of discussed from time to time, the residential property market is still holding up at the moment. We've actually seen a bolster in a lot of the equities and basically the companies that are publicly traded for new home developments, right? We've been seeing a lot of the home builders doing quite well and continuing onward as we're seeing home buyers buying new homes. But we want to look for signs here, not only in new homes, but also old homes as well as to where we are in the economy right now. So interestingly enough, and I think we can all agree we're never going to probably get back up, especially with the population growth of the United States, but the lack of the kind of overt stimulus we put into the housing market specifically, I don't think we're ever going to get up to this range here for a very long period of time for new homes, basically existing home sales, right? So we had a range of 7.2 up here in the millions, or it's 7.2 million. And we're still weighing around this range that we topped out back here in 2010 and here in 2017 and 18, right? So we're actually so far at a lower level. We haven't gotten up to 5.7 million. So it'll be interesting to see if we'll be able to in some way be able to get past those levels, or if we generally push sideways and start to topple over going into the mid-2020s and possibly enter into a recession. that's what I'm going to be watching for. Again, this is not something you have to check every day, guys. I like to check it every month, every 2 months. I like to see where the housing market is going because it's a good sign of where the economy is directing. If people aren't buying and making those long-term purchases, right? If they don't have either the credit to be able to take out the mortgage, or the mortgage rates are getting too high to where they don't see it as a worthy investment, then in that case, it's a good sign that the economy is getting a credit crunch of some sort, right? That they're finally, people are having to start to pay down debts. They're not taking on those big purchases, right? They're not taking on new debt in the form of mortgages. Another thing to look at as well is new residential building permits. Now, the data here is, you can see it in a positive or negative light, right? So right now, this is the 6-month average, right? So you have all these different dots. These are the permits per month, right? So to get a more consistent line here, rather than the kind of sporadic nature of these different permits, we can get a 6-month moving average here, which is basically what this blue line is, hovering around the different levels of permits. And we can see here how it plays into recessions. We see the decline here initially, and then we enter into the official recession, 2 quarters of GDP, where we see a decline. But we can see here again, we're still maintaining a general uptrend here, right? We're still setting relatively higher lows and higher highs here. It'll be a matter if we can continue that here with the average and break above. Right, this is the current level here across the board, right between kind of the middle range here. So we haven't reached anywhere near the kind of crazy peaks we've seen in the past from the early 70s to here in the 2000s. Will we reach towards that range? Probably not. I'd say the even more overt bullish case would be somewhere around this range here, where we're somewhere around 1.75 million properties, right? So that would be something that I would look at for a 6-month average. But at the end of the day, the major thing to watch for here is if there is any kind of trend reversal. So far, we haven't gotten it. The interesting thing I will say, though, is the permits as a percent of population, right? So we have seen a general downward trend here. And again, it's very similar here where we're at the moment. We're right along the trend line. And just in this case, we're a little bit higher. But you can see here that over time, this number is going to decline. So we should expect this to be topping out at slightly lower ranges, right? But to be completely against my old ways, to be against my bearish viewpoint, gotta say that it looks like the space still has some room for growth. And to be fair here, guys, the reason I say that is, we've been seeing the Fed basically go back into markets in reverse on its balance sheet. If you guys don't know what's been going on repo markets, they have not only been exchanging treasuries in this case, right? They've been exchanging the treasuries for short-term capital, but the Fed has been adding back to its balance sheet as well, like long-term purchases, and they've been buying back mortgage-backed securities, right? So in this case, they're buying back a share of this market in order to provide basically relief into the housing market, right? If you're taking these assets off the books, right? These, again, it doesn't matter if these are like multi-decade mortgage-backed securities. Mortgages are a multi-decade investment, right? You are basically, they're multi-decade loans in this case, but in a sense you can see it as an investment because people are paying them down over the long term, right? The fact of the matter is that when you buy those mortgage-backed securities, you are buying up potential assets that could be bought by their investors. And because of that, this is leaving more capital on the market. This is leaving more of an ability, especially if you have lower interest rates, for people to go out and take on new mortgages, stimulate the housing market, prop up prices, right? This is the kind of element here is there's so many things going on, but everything that the Fed can do right now to stimulate the housing market and the broader asset market, they are doing at the moment. They are providing the short-term capital required for repo markets to keep going along, even though there was a severe problem that we still don't know what actually happened. And they're also stimulating the economy with cutting down interest rates. Going today, actually, I think Powell is going to talk to Trump about negative interest rates. So it looks like we're becoming Japan, or like the rest of Europe, and we're all going to be living in La La Land over the next few years. So it's going to seem crazy. I know it doesn't make much sense, but you can't deny that it's going to stimulate assets. People are chasing a yield. They're going to buy properties. They're going to invest in stocks. It's the only way they can really make money in this market. They surely can't get it investing in foreign government bonds where the yields are negative. They're going to be putting it in assets. You're forced to do it. It's that simple, right? So anyways, I'm not saying you guys are forced to do anything. You gotta invest where you want to invest. But if you like this video, drop a like. I always appreciate it, guys. You guys can leave a comment as well as to what you think about all this. What's your thoughts on the market at the moment? And if you guys want to support me, feel free to check out the links down below. If you guys haven't already, I haven't talked about it in a while. It's still in the works and everything. We're working on my startup at the moment. So if you guys want to go ahead and click on the link Banking for the 21st Century, you can sign up for the email alerts to I'll basically let you guys know when we launch. I'm not going to spam you with a ton of stuff. Just want to let you all know when I actually launch the startup and everything, so you guys can test it out. All right. So anyways, that's going to be it for the video, everyone. I hope you have a wonderful rest of your day, and I'll see you all in the next video. Stay tuned.